Good morning. This is Tony Cherniawski, President of the Practical Investor, LLC. Today is Friday, October the 17th, 2008. The name of this program is Options Madness and the Crash of 1987. Did you know that today is the 21st anniversary of the crash of 1987? A lot of people don't really remember what happened back then, and I'd like to give you a review of history to help you to understand the cause of the crash and what's happening today as well. This will give you some insights into the markets. The first thing that I want to say is that 1982 was a pivotal year in the market. This was the first major test of the market lows that occurred in 1974, and the market succeeded in not taking out those lows but establishing a higher low from which it could launch a major bull market. What we saw was 5 continuous years of bull market with nary a correction in the midst of it at all. This led to people having a diminished awareness of risk over time. This is one of the things about human nature that's real important for us to realize. The longer we stay away from major events in the market, the less we remember them. And this was a major thing that, in 1982, it was very hard to get people into the markets. I can attest to that because I was in the business then. But over time, people started piling on quite dramatically. A lot of silly ideas started coming out of the market at that time because people were still concerned about hedging against risk. One of the ideas was called portfolio insurance, in which people thought that they could defend themselves against loss in the market by buying when the market went up and selling when the market went down. It kind of sounds like buy high and sell low, doesn't it? But it seemed to work at the time, and the mathematicians obviously weren't on the trading floors to examine their model at all. So this type of silliness started to pop up in the market, and this became a matter of concern for thinking individuals. Some of the larger portfolio managers started buying portfolio insurance in another form. They called these put options, in which they could hedge against market risk. Put options have a dark side, however, and this is important to know. They were calling this portfolio insurance, and Wall Street was the one that actually used the terminology most often. But buying options is not the same as buying insurance. Let's explain why. If you have hundreds or even thousands of homeowners who collectively insure against the loss of their house by a fire, this is called a pooling of money against a specific risk. That specific risk is possibly the potential of only 1 or 2 houses catching fire out of either hundreds or even thousands of homes. However, insurance companies don't insure against certain types of risks in certain parts of the country. For example, if you lived on the Gulf Coast, you can't buy flood insurance. The reason why is that the risk is both unknowable and unmeasurable. This is a very important concept that people who discuss insurance often miss. The same thing happens on mountainsides in Southern California, where people cannot get fire insurance because the risk is, again, immeasurable and unknowable. So what happens is that behavior, though, becomes a bit more risky simply because the last event that happened is further and is pushed down in memory by time. And as a result, people, for example, on the Gulf Coast continue to build more homes right up to the beachfront, especially right up on the beaches themselves. And in addition to that, you might see small neighborhoods on the mountainsides of California becoming very large neighborhoods simply because fires haven't been around for the last 20 years. This is an error in judgment, as many people can attest. Now, let's talk about what happened with the crash and how this came about. First of all, what we see is that the market peaked on around August the 25th, 1987, and the peak was at 337.88. Okay, this was the peak in the market. We had approximately a 10% decline down to 308 on the 10th of September, and then another decline on around the 17th of December. Or September rather. Then the market rallied back up to 328.93 on the 3rd of October. I think this probably was the point when some portfolio managers probably purchased a lot of put options because they saw that the risk had suddenly changed. The risk parameters had changed. And one of the things that changed it was the increase in volatility. As a result, during options expiration week, we saw almost an 11% decline from 328.93 down to roughly 300 and it was somewhat below 310. And what we saw here was the triggering of these put options that had to be paid on the 15th of October. The following day, there was a rally where it looked as if the loss was only about 4 or 5% instead of the 10 or 11% that we saw the day before. However, the put options were triggered on Thursday for index options, and for stock options were triggered on Friday. Many people thought that the market was done going down, and so they bought into the market on Friday afternoon, thinking that the rally would start to extend again like it had in the past into the next week. This led to a lot of scrambling on Monday morning when the market actually opened down and continued to go down for 2 days at the rate of a 31.5% loss. So from the August high to the October low, we had a 41.6% loss, but 31.5% of that occurred within about a 5 to 6 day period in the market. So I just wanted to cover that first of all, and then talk about what actually caused this loss to occur. Well, people who sell options have two ways to minimize risk. One is called delta hedging. Delta hedging is where a hedge or put seller, rather, or an option seller, will sell an equal number of puts and calls. This doubles the premium income that's paid to him, and as a result of that, these option premiums can be used to offset losses of up to 2 or 3% in either direction. These are the kinds of losses that the market is generally used to 90% of the time. It's the other 10% that they have lost the awareness of, especially in a 5-year continuous rally. As a result, that 10% loss actually triggered a greater loss because options are leveraged. And as a result of that, a 10% decline in the market could cause a 50, 80, or even 100% decline on the options that are sold. As a result, there's only one other way to hedge if you haven't the money, deep pockets to absorb that kind of liability, and that is to sell the market short. And that's exactly what happened on Friday. That rally on Friday was an uptick that people could sell short the market, and we saw a decline in which there were virtually no buyers the entire day on Monday the 19th. This information is meant to be educational and not meant to give any kind of specific trading advice. What I'd like to do is just bring you up to speed on the history of the market and what causes certain events to happen, and I'll be back with follow-up information on how the options market is affecting the stock market today. You can reach me at TonyC@thepracticalinvestor.com. My website is www.thepracticalinvestor.com. On the front page, you'll see in smaller print the term crash warning. Please read that article, and it gives you some background on the things that we discussed today. Thank you, and do the right thing.